Welcome to episode 8 of the MLO Exam Prep Podcast. In this episode, we'll focus on the ethical and legal responsibilities of mortgage loan originators, covering fair lending laws and consumer protections, prohibited practices and mortgage fraud, regulatory compliance and industry standards. Ethics and compliance are critical for both the exam and real-world mortgage lending. Let's get started. The importance of ethics in mortgage lending. Why does ethics matter? Mortgage professionals have a fiduciary responsibility to act in the best interests of borrowers. Key ethical responsibilities of an MLO. Provide honest and accurate information to borrowers. Ensure borrowers understand loan terms, risks, and costs. Avoid deceptive or misleading practices. Prevent steering borrowers toward high-cost loans for profit. Common ethical dilemmas in mortgage lending. Misrepresenting a borrower's income to qualify for a loan, encouraging a borrower to take on a higher loan amount than they can afford, failing to disclose fees or prepayment penalties. Exam tip. A test question may ask, what is a fiduciary responsibility? The correct answer is the duty to act in the best interest of the borrower. Fair lending laws and consumer protections. The Equal Credit Opportunity Act, EOA, regulation prohibits discrimination in lending based on race or color, religion, national origin, sex, including gender identity and sexual orientation, marital status, age, receipt of public assistance, MLO responsibilities. Under ECOA, ensure all applicants are treated fairly. Provide a written notice of loan denial, adverse action notice within 30 days. Explain why credit was denied if the borrower requests it. Exam tip. A question may ask, which law prohibits discrimination based on marital status? The correct answer is ECOA. The Fair Housing Act, HA. The Fair Housing Act prohibits discrimination in housing-related transactions, including mortgage lending. FHA protections cover race, color, and national origin, religion, sex, gender identity, and sexual orientation, disability, familial status, e.g. having children under 18 in the home. Exam tip. A question may ask, which law protects against discrimination based on familial status? The correct answer is the Fair Housing Act. The Home Mortgage Disclosure Act, HMDA, Regulation C. The HMDA requires lenders to collect and report mortgage loan data to prevent discrimination. Key HMDA requirements. Lenders must collect data on loan applications, including borrower demographics. Data is submitted annually to the CFPB to monitor fair lending compliance. Exam tip. A question may ask, what is the purpose of the HMDA? The correct answer is to monitor lending practices and prevent discrimination. The Truth in Lending Act, TILA, Regulation TILA promotes transparent lending by requiring lenders to disclose loan terms, costs, and APRs. Key TILA protections. Lenders must disclose the total interest percentage and APR. Consumers have a 3-day right of rescission for refinances. Prohibits misleading mortgage advertising. Exam tip. A question may ask, what is the purpose of TILA? The correct answer is to ensure borrowers receive clear and accurate loan cost disclosures. Closing thoughts on Part 1. Key takeaways. MLOs have a duty to act in the best interests of borrowers. The ECOA and Fair Housing Act prohibit discrimination in mortgage lending. The HMDA ensures lenders report data to prevent discriminatory lending practices. TILA requires lenders to provide clear loan disclosures and prohibits misleading advertising. In Part 2, we'll cover prohibited practices and mortgage fraud, high-cost and predatory lending protections, the role of the CFPB in mortgage regulation. Stay tuned. Welcome back to Episode 8 of the MLO Exam Prep Podcast. In Part 1, we covered the importance of ethics in mortgage lending, fair lending laws, FHA, HMDA, TILA, consumer protections in the mortgage industry. Now, in Part 2, we'll discuss prohibited practices for MLOs, mortgage fraud, and high-cost lending, the role of the CFPB in mortgage regulation. Let's get started. Prohibited practices for MLOs. What actions are prohibited? MLOs must comply with federal and state regulations to protect consumers. Prohibited practices include misrepresenting loan terms to borrowers, failing to disclose loan fees and costs, engaging in steering or predatory lending, committing mortgage fraud, e.g., falsifying documents, discriminating against borrowers in violation of ECOA or FHA, violating anti-kickback rules under RESPA. Steering and loan suitability. Steering occurs when an MLO directs a borrower toward a specific loan product for personal gain rather than the borrower's best interest. Example of steering. A loan originator pushes a borrower toward a high-cost loan with a higher commission rather than a better-suited, lower-cost option. Exam tip. A test question may ask, which federal law prohibits loan steering? The correct answer is the Loan Originator Compensation Rule, TILA. Mortgage fraud and high-cost lending. What is mortgage fraud? Mortgage fraud occurs when false information is used to obtain a mortgage loan. Types of mortgage fraud. Fraud for housing. A borrower misrepresents income, employment, or occupancy to qualify for a loan. Example, stating that an investment property is a primary residence to obtain better loan terms. Fraud for profit. Industry professionals manipulate transactions for financial gain. Example, an appraiser inflates a property value to justify a higher loan amount. Exam tip, a question may ask, what is an example of fraud for housing? The correct answer is a borrower misrepresenting their income to qualify for a larger loan. High cost and predatory lending protections. HOPA, Home Ownership and Equity Protection Act, TILA Section 32, regulates high-cost loans and prohibits predatory lending practices, requires additional disclosures and borrower counseling for high-cost loans, prohibits balloon payments, negative amortization, and prepayment penalties in high-cost loans. Exam tip. A test question may ask, what law provides extra protections for high-cost loans? The correct answer is HOPA, TILA Section 32. The role of the CFPB in mortgage regulation. The Consumer Financial Protection Bureau, CFPB, is responsible for enforcing federal mortgage laws and protecting consumers. Key responsibilities of the CFPB: enforces fair lending laws, ECOA, HMDA, FHA, RESPA, TILA, investigates mortgage fraud and predatory lending, monitors mortgage lenders and loan servicers for compliance, issues penalties for regulatory violations. Exam tip, a question may ask, which agency enforces federal mortgage lending laws? The correct answer is the CFPB, Consumer Financial Protection Bureau. Final exam-style quiz questions. 1. Which law prohibits an MLO from steering a borrower into a high-cost loan for personal gain? A. ECOA, RESPA, C. The Loan Originator Compensation Rule, D. The Fair Housing Act. The Loan Originator Compensation Rule prohibits loan steering. 2. Which of the following is an example of fraud for housing? A. An MLO inflating a borrower's income to qualify them for a loan. B. A lender offering a borrower multiple loan options. C. A borrower using their primary residence as collateral. An MLO reporting a borrower's true income on their application. Correct answer, misrepresenting income or employment is an example of fraud for housing. 3. What law regulates high-cost loans and protects consumers from predatory lending? A. RESPA, C. ECOA. Correct answer, B. HOPA, TILA Section 32 regulates high-cost loans. 4. What is the primary function of the CFPB? A. To regulate the stock market. B. To enforce federal mortgage laws and protect consumers. C. To approve all mortgage loans. D. To ensure VA and FHA loans. The CFPB enforces mortgage lending laws and protects consumers. Closing thoughts on Part 2. MLOs must follow ethical lending practices and avoid steering borrowers toward unsuitable loans. Mortgage fraud includes both fraud for housing, borrower misrepresentation, and fraud for profit, industry manipulation. HOPA protects consumers from predatory lending in high-cost loans. The CFPB enforces mortgage regulations and protects borrowers. In Part 3, we'll conclude Episode 8 by covering compliance with anti-money laundering AML laws, Privacy and Data Protection, GLBA, and FTC Safeguards Rule. Final Ethics and Compliance Quiz. Stay tuned. Welcome back to Episode 8 of the MLO Exam Prep Podcast. In Parts 1 and 2, we covered ethical lending and fair lending laws, prohibited practices and mortgage fraud, high-cost lending and CFPB oversight. Now in Part 3, we'll discuss anti-money laundering, AML, and suspicious activity reports, privacy and data protection, GLBA and FTC Safeguards Rule, final ethics and compliance quiz. Let's get started. Anti-money laundering, AML, and suspicious activity reports. What is money laundering? Money laundering is the process of concealing illegally obtained funds by making them appear legitimate through financial transactions. Why is money laundering a concern in mortgage lending? Criminals may use real estate transactions to launder money by purchasing property with illicit funds. Fraudulent loan applications can be used to move large sums of money undetected. The Bank Secrecy Act, BSA, and anti-money laundering, AML rules. The Bank Secrecy Act, BSA, requires mortgage lenders and financial institutions to detect and report suspicious financial activity. BSA requirements: monitor mortgage transactions for suspicious activity. File suspicious activity reports, SARS, with the Financial Crimes Enforcement Network, FinCEN. Maintain an AML compliance program to prevent financial crimes. Exam tip. A test question may ask, what federal law requires financial institutions to report suspicious mortgage transactions? The correct answer is the Bank Secrecy Act, BSA. Suspicious activity reports, SARS, and red flags. When must an MLO file a suspicious activity report? A suspicious activity report must be filed if a transaction appears fraudulent or linked to money laundering. Red flags for money laundering in mortgage lending: large, unexplained cash deposits for a down payment, a borrower with no verifiable employment purchasing an expensive property, a series of transactions structured just below reporting thresholds, multiple properties purchased in a short time with little financing documentation. Who files the SAR? The mortgage lender or financial institution, not the MLO personally, must file a SAR with FinCEN within 30 days of detecting suspicious activity. Exam tip. A question may ask, what is the required time frame for filing a suspicious activity report? The correct answer is within 30 days of detecting suspicious activity. Privacy and Data Protection, GLBA, and FTC Safeguards Rule. The Gramm-Leach-Bliley Act, BA, Regulation P. The GLBA protects consumers' non-public personal information, NPI, and requires financial institutions to safeguard borrower data. Key GLBA requirements. The Privacy Rule. Financial institutions must provide a privacy notice explaining how consumer information is shared. The Safeguards Rule. Lenders must protect consumer data from unauthorized access. The Pretexting Rule prevents identity theft and fraud by prohibiting the use of false pretenses to obtain consumer information. Exam tip. A question may ask, which law requires financial institutions to protect consumers' personal information? The correct answer is the Gramm-Leach-Bliley Act, GLBA. The FTC Safeguards Rule. The Federal Trade Commission FTC Safeguards Rule is part of the GLBA and requires financial institutions to develop security programs to protect customer information. Requirements under the FTC Safeguards Rule: create and implement an information security program, conduct risk assessments to identify vulnerabilities, use encryption and other security measures to protect borrower data. Exam tip. A question may ask, what is the purpose of the FTC Safeguards Rule? The correct answer is to ensure financial institutions protect borrower data. Final exam-style quiz questions. 1. What law requires mortgage lenders to report suspicious financial activity? A. RESPA. B. The Bank Secrecy Act. BSA. C. The Fair Housing Act. D. The Home Mortgage Disclosure Act. Correct answer, B. The BSA requires lenders to report suspicious transactions. 2. When must a suspicious activity report be filed with FinCEN? A. Within 10 days. B. Within 30 days. C. Within 60 days. D. Within 90 days. SARS must be filed within 30 days of detecting suspicious activity. 3. What type of borrower behavior might indicate money laundering? A. A borrower provides multiple verifiable sources of income. B. A borrower makes a large cash deposit with no documentation. C. A borrower pays a mortgage on time every month. D. A borrower asks about different loan programs. Correct answer B. Unexplained large cash deposits are a red flag for money laundering. B4. What does the Gramm-Leach-Bliley Act, GLBA, require lenders to do? A. Report credit information to the CFPB. B. Allow borrowers to waive loan disclosures. C. Protect consumers' non-public personal information, NPI. D. Disclose all loan terms in a loan estimate. Correct answer C. The GLBA requires lenders to protect consumer data. 5. What is the purpose of the FTC Safeguards Rule? A. To regulate high-cost loans. B. To ensure financial institutions have security programs to protect borrower information. C. To prevent discriminatory lending practices. D. To establish guidelines for loan origination licensing. Correct answer. The FTC Safeguards Rule requires institutions to protect borrower data. Closing thoughts on Part 3. Key takeaways. The BSA and AML rules require lenders to monitor and report suspicious transactions. SARS must be filed with FinCEN within 30 days of detecting suspicious activity. The GLBA and FTC Safeguards Rule protect borrower data and require financial institutions to implement security measures. This concludes Episode 8, Ethical and Legal Responsibilities of MLOs. In Episode 9, we'll cover the mortgage loan servicing process, escrow accounts and loan payoff procedures, delinquencies, foreclosures, and loss mitigation. Thanks for studying with us.